guys, it's Stock Curry, and it was another bloodbath in the markets today, but the good news is there's some dip buying opportunities coming up on the horizon. In today's video, I'm going to give you the best stocks to buy the dip on, as well as an update on AMC. So let's get into it! But before I start talking about these stocks, I want to remind you that I am not a financial advisor. Nothing I talk about today is a recommendation to buy, sell, or hold. These are just my opinions, which may or may not be accurate. So please do your own research before investing in any asset. All right, let's get into these stocks. And we're going to start with an update on AMC. This is AMC Movie Theaters. And Keenan Gray said AMC is getting close to a buy zone, but it's not there yet. I agree, and like I said earlier, I will buy back into AMC once it hits $14.50. I don't want to buy in yet because it's still a falling knife. But with a strong $14.50 support level coming up, that will be a strong buy-in price for me. And the next stock we're going to talk about is AMD. This is Advanced Micro Devices, better known as AMD. Joseph Hogue listed AMD as one of the 5 best growth stocks to buy now. He said that while you might not think of AMD as a growth stock, it has been lately. AMD grew revenues by 45% in 2020, and the past 3 quarters have been even better with year-over-year revenue growth at 93%, 99%, and 54% each quarter. That gives AMD an average 64% annual revenue growth over the past 2 years. At that rate, AMD should be trading at a PE of 75, and it's currently at around 55. So based upon the revenue growth, AMD should have about a 36% upside potential from here. That would give AMD a price target of $175. Instead of rising though, AMD has been dropping for the past 6 weeks. AMD is now in bear market territory, down over 22% from its high. Although AMD is at the 100-day EMA, which might be a level of support, it is not showing any signs of rebounding yet. So there's still a chance that AMD might continue to fall further. If you're interested in buying AMD, I would be patient and wait for the technicals to show some signs of bottoming out and rebounding before buying in. And next up is COIN. This is Coinbase. This is a platform that is used to trade cryptocurrencies. Joseph Hogue listed COIN as one of the 5 best growth stocks to buy now. While COIN might be valued based upon their crypto fees for now, Joseph Hogue thinks Coinbase's revenue will expand rapidly once they get into NFTs and other assets. And Joseph Hogue also thinks there might be a merge opportunity for COIN to get bought out by a traditional bank. The only problem with that theory, though, is that national banks are not allowed to offer crypto services, so the odds of a bank partnering with Coinbase in any way is slim. Now, fundamentally, COIN is seeing massive revenue growth up until last quarter when crypto started to fall in price. I believe this quarter they will report another decline in revenue growth as cryptocurrency has continued to fall in price. So far, COIN has held very strong support at $216. But if COIN falls below that $216 price level, as it very well might if they report another quarter of declining revenues, then there's no telling how low the price will fall. I would wait until after earnings are reported to see if COIN holds the $216 technical level or not. Earnings are expected to be released in about 3 weeks. If revenue comes in at or above what COIN did last quarter, then that will make the fundamentals of COIN cheap, and that would be a great buying opportunity. But if revenues come in lower than what they did last quarter, as I suspect they will, then we'll have to recalculate the fundamentals to determine where COIN should be trading at. So for now, this is a hold for me, and I would wait 3 weeks to see what COIN reports for earnings before doing anything. Next up is NVDA. This is Nvidia. Joseph Hogue listed NVDA as one of the 5 best growth stocks to buy now. NVDA has been a key player in both EVs and the metaverse. While revenues took a hit during the start of the pandemic in 2020, they rebounded sharply throughout the rest of 2020, with revenues up over 50% year over year. And the revenue growth accelerated in 2021, with NVDA averaging a 67% year-over-year revenue growth over the past 3 quarters. It's hard to say if that revenue growth will continue, but if it does, NVDA should be trading at a PE ratio of around 70. The current PE ratio is 77, so I do see NVDA as fairly valued right now. That said, if NVDA continues to drop, especially if it drops down to that 300-day EMA at around $200, then that would be a buying opportunity for me. We'll just have to see where NVDA bottoms out once this bear market is over to see how much upside potential NVDA ends up with. And next up is PLTR. This is Palantir and their data analytics company. Invest with Henry gave his reasons why he thinks PLTR is undervalued. He pointed to their rapid international expansion and the growing market that they're in. Invest with Henry said that even if PLTR only captures 10% of the market, revenues will still increase 850% from here. Of course, that's a big if, and right now PLTR just isn't growing revenues fast enough to support that. Right now, PLTR is only growing revenues by 4 to 9% per quarter, or about 30% per year. At that rate, we should be seeing a future PE ratio of around 40. But the current forward PE ratio is 96, or more than double where it should be. I get that a lot of people are ultra bullish on PLTR, but from a fundamental standpoint, it's still trading at double where it should be. I believe in PLTR long term as much as anybody, but I would not at all be surprised to see it drop down to $7 or $8 per share by the time this bear market is over. Jeremy with Financial Education reviewed an article where someone said PLTR should be trading at $5 per share. Now, while I think that's a little low, because as Jeremy pointed out, that would give PLTR a price to sales ratio of only 5, I acknowledge that it could actually drop that low if this bear market runs longer than expected. Regardless, Invest with Henry is super bullish on it long term, and he thinks PLTR will rebound back up to $20 or $30. Henry is looking at the fact that the RSI is oversold right now at 23. While PLTR might bounce back up to $17 or so in the short term, it's not showing any signs of rebounding yet. And during the rest of this year, I do think PLTR will continue to drop in price as it's not yet profitable. So it will be a prime candidate for short sellers and others who dump unprofitable growth stocks, since unprofitable growth stocks are at the greatest risk of losing money during rising interest rates. And next up is SHOP. This is Shopify, and they're the second largest e-commerce company in the world, right behind Amazon. Joseph Hogue listed SHOP as one of the 5 best growth stocks to buy now. He likes how SHOP continues to take market share away from Amazon. SHOP is growing revenues by anywhere from 50 to 85% per year, and they just turned profitable last year and continue to be profitable this year. Based upon the past 3 quarters, SHOP has a price to earnings ratio of 30. Given SHOP's current revenue growth rate though, they should be trading at a PE of 85. So based upon the past 3 quarters, SHOP should be trading at 3 times where it is right now. SHOP is down 41% over the past 2 months, and there is literally no reason for the drop other than the overall market bearishness. SHOP is one of those stocks that I believe will be a big winner once this bear market is over. Now, just because SHOP is cheap right now does not mean it will bottom out and rebound from here. It could keep falling. So we have to look beyond the fundamentals and look at the technicals also. Technically, SHOP is a falling knife. The good news is that SHOP is oversold in the RSI, so there is at least a chance that the dropping will slow down soon. SHOP is also near a support level of $1,040, so that could provide more relief from the free fall. On the other hand, if SHOP continues to fall, the next support level isn't until $880. So while SHOP is undervalued fundamentally, it remains a falling knife technically. While I really like SHOP for a long-term play, I would wait for it to bottom out and show signs of rebounding on the technicals before buying in. And next up is SoFi. This is SoFi, and they're an online fintech startup. Now that SoFi has been approved for their bank charter, it's time to reevaluate where the price might go from here. Now, even though the price ran up 13% on Wednesday, I actually see that as a bad thing. SoFi should have run up considerably more, considering how good the news was. Stockmo still remains bullish in SoFi, and he continues to add on to his position, but I'm concerned that it might continue to fall. No analysts have updated their price targets yet, so I'm still waiting to see if analysts are going to become more bullish on SoFi or not. SoFi will continue to be the target of attacks by short sellers over the next year as interest rates rise and unprofitable growth stocks struggle to gain upward momentum. So I would wait a few days to see if SoFi can establish a new direction upward, or if this is just going to end up being a dead cat bounce that results in more pain for bulls. And last up is ZM. This is Zoom. Joseph Hogue listed ZM as the last of the 5 best growth stocks to buy now. While ZM saw massive revenue growth in 2020 due to the shutdowns, their growth rate slowed in 2021, with a year-over-year revenue growth just 35% last quarter. Despite the slowdown in revenue growth, the fact that ZM continues to grow revenues after a breakout year in 2020 is very impressive. But because of the recent one-off rockstar year, it's very hard to tell where ZM should be valued. I'm going to guess that revenue growth will continue to slow, and I would say a PE of around 40 would be fair for ZM. And that is exactly where the PE ratio is right now. So I don't think ZM is undervalued like the rest of the stocks Joseph Hogue gave. This one I think is actually at a fair value. So I would not buy ZM unless it drops significantly from here, and then in that case, I would be looking for a rebound back to a fair value of around $150. Alright, I hope you enjoyed this video and got a lot out of it. Comment down below what you're buying the dip on. And I also wanted to let you know that the $1 Million Challenge portfolio was up 6% today. If you're tired of seeing red in your portfolio and you're ready to see some green, I also wanted to let you know that I have started a coaching program. In the coaching program, I will walk you through this entire bear market. I will hold your hand, answer every question you have, and help you see some green in your portfolio. And is it worth it? You bet it's worth it. Invest for Life said this coaching tidbit just saved me big time. This is such a valuable service you offer. Now, if you need your portfolio saved, then I want to encourage you to sign up for our coaching program. It's just $25 a month, but if you sign up right now, you can save $5 a month and pay just $20 a month for life. If you're interested in that, or if you want to learn more, you can go check out stockcurry.vip/coaching. That's stockcurry.vip/coaching. All right. If you have not yet done so, please remember to hit that like button and subscribe. And if you're on YouTube, click the bell icon and click all. That way you'll get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.